Hey guys, what's going on? Jeb here, and in today's video, a death cross is coming to Bitcoin. Now you might be wondering, oh Jeb, didn't you just say the golden cross happened like a week and a half ago? Well, yes, but see, you need to understand something, and that is that golden and death crosses are not only to do with the 50 and the 200. Technically, a death cross is when a shorter term moving average crosses below a longer term one, and as you can see on your screen right now, the 20 exponential daily moving average is crossing below the 50 daily simple moving average, and if we look at the history of that, which we will be doing in today's video, that's actually a pretty big deal, and that does signal the beginning of a new downtrend. These kind of crosses have shorter term implications, so this isn't the end of the bull market or anything necessarily, but it is something that you guys need to be aware of, so we're going to be diving into that in today's video. We're also going to be talking about a few other things. We're going to be discussing the yield curve and the kind of U-shape that it's taking right now, and whether or not that's calling for a recession on global markets and potentially in Bitcoin. But anyway, guys, if you do enjoy today's video, please consider hitting that like and subscribe button. It really helps out the channel when you do that, and I wouldn't want you to miss any future videos. So without much further ado, guys, let's go ahead and dive right on into it. I don't know if you guys are aware, but I'm a mermaid at heart. That's what my mug says today. So, yeah, I just thought you guys ought to know that. So guys, as you can see on our chart, we have the 20 exponential moving average and the 50 simple moving average plotted on our screen. And as you can see today, and especially tomorrow, we're going to be seeing a cross between the 20 and the 50 with our line up here. I want to say that's yellow. It might be green. Guys, I don't know. I'm colorblind. Bear with me here. The 20 exponential moving average up here on top is crossing below the 50 down here on the bottom. And even though that's not a cross between the 50 and the 200 like normally a golden and death cross would be, it is significant because a shorter term moving average is crossing below a longer term moving average. That is partially resetting the alignment of those moving averages that we've discussed in many videos, and also in this video in the Cryptocurrency Technical Analysis Academy right here, golden and death crosses. The alignment of those moving averages, if we bring up our other two, the 100 and the 200, is very, very important. We want the 20 up here, the 50 right there, the 100 right there, and the 200 right there. This right here is a bullish alignment of moving averages, but when you have crosses, it resets that alignment to a more bearish alignment of moving averages, like what we saw over here where we had the 200, the 100, the 50, and the 20. Not bueno. So of course, no technical ought be used in vacuum, so let's look at the history of this. As we can see, back on January 6th, there was a golden cross between these two moving averages, and it pretty much kicked off this new rally that we saw Bitcoin move into for the next 2 months. As you can see here, we had a bit of a lagging golden cross to signal this rally, and then very soon thereafter, we had a lagging death cross to signal this pullback. And back in the 2019 rally, we saw that Bitcoin had a cross right down here, around $3,600 back in February of 19, and that would lead to this entire move to the upside. It's an important technical, and it definitely does have historical and technical relevance to our chart, so it's something that we ought to be looking at and taking heed to. As we discussed in this video in CT2A, how to spot a winning indicator and pattern. Whenever something has historical precedent and a lot of people are looking at it, it's going to be important because people are going to be trading off of it. People are going to be trading by this, and people are going to be seeing this as a bearish signal. Speaking of bearish signals, I also want to show you guys the longs chart because the longs have been jumping off the metaphorical cliff in a bit of a blood fall here over the last 2 weeks or so. We've seen 3 green candlesticks, and 2 of those, quite frankly, were little nerds, and they didn't really mean nothing at all. We had one right there. Other than that, though, Bitcoin's longs have been in a pretty substantial downtrend, pulling back from 47,000 to 32,000. That is, if I check, about a 32% reduction in longs. That is definitely a signal of the sentiment in the market and the investors and the traders in the space of bearishness, which is a very important signal to be reading. That's why you need to be looking at those longs and shorts. One thing to also mention, guys, that the RSI is getting down to pretty oversold territories. We're sitting around 33, 34. Typically, RSI is going to go no lower than 30 on the daily chart for Bitcoin. If you look back in the history here, not very often does Bitcoin go below this level right here on 30. It does sometimes, but normally when it's doing that, there's something significant going on in the market, like a break of $6,000 that we saw in on the 19th of November, 2018. I remember that day like it was yesterday. Tell me, where were you guys when Bitcoin fell below $6,000? It was one of those things where I remembered where I was. I was at Metro Diner in Gainesville. One thing that is slightly bullish here is that we're seeing a green candlestick on the histogram for the MACD, which means that we are seeing a little bit of convergence. That would more than likely be because of the small green candlestick that we have in play right now, and because the MACD has already diverged so much that it's very easy for it to converge on itself and hard for it to diverge any farther, because that's how these kind of markets work. They are self-regulating. They always want to go back to that zero level. The oscillators, they always want to go back to whatever their mid-level is. On MACD, it's 0. And of course, in this case, for the MACD to do that, there would have to be a bullish cross. It's a bit of a self-regulating force there. Okay, so guys, that's a look to the technical landscape of Bitcoin and the cryptocurrency markets right now. You guys know that I personally believe Bitcoin's pulling back to around $7,600, $7,800, maybe $8,000, somewhere in that region. That's where I'm expecting a pullback to. We discussed that in yesterday's video with this little prediction right here about how Bitcoin might come down. It's probably going to come down and get support at the 100 right there. It's probably going to bounce just a little bit to fulfill that head and shoulders pattern, and then it's going to move even farther to the downside as the news continues to spread. So guys, with all that said, let's go ahead and move on to something that I didn't cover in our video where we were discussing the possibility of a new recession coming, and a few of you mentioned it in the comments section. That would of course be an inverted yield curve. I didn't leave the yield curve out of that video because I'm not aware of what a yield curve is. I left it out because the yield curve right now is not really inverted or standing properly. It's a U, which doesn't happen a whole lot. It typically is something that happens in the process of an inversion. As you guys can see here, we're on a website called gurufocus.com/yield_curve.php. There you go. And here on this website, we can see the yield curve, and we can see right here what it looks like if you were to graph it. Back up. What is a yield curve first? Well, guys, this is going to be a bit of a simplistic explanation of it. I want you to go do your own research if you're not familiar with yield curves. But essentially what a yield curve is it's a graph that shows you the percentage return that you're going to get on a treasury bond based on how long you lock that money in for. So if you get a 3-month treasury bond, a 2-year treasury bond, a 10-year, a 30-year treasury bond, what is the interest rate that you're going to be locking in if you entered one today? Typically, when you lock in that money into a treasury bond, the longer you lock it in there for and give that money to the US government and they pay you back, the longer you lock that in, typically the more it's going to pay you in percentage returns. That's not the case when the yield curve inverts. Let me show you what I mean by that. As you can see right here, we have our yield curve graph. On the 1 month, we have a 1.45% return on a treasury bond. Down here on the 3-year, we have a 0.85% return on a treasury bond, which is a little bit, that's like right around inflation. That's not good. And then the 30-year treasury bonds up here are around 1.65% in return if you were to get one today. Typically, you want to see a treasury yield curve look normal and slope to the upside like we saw here in 1984. Back when interest rates were a lot higher, a 3-month yield was 10% and a 30-year yield was 12.5%. If only you could loan Uncle Sam money and get 12.5% back nowadays. Good Lord, you guys, they were like alive and jeez. Good luck buying a home with that much interest, though. Holy crap. But as you can see right here in 2000 and in 1981, before a couple of recessions, we could see that the treasury yield curve was either flat or sloping to the downside. Here in 1981, a 1-year yield was 15%, but a 30-year yield was 12.5%, just a little bit higher than that. This would be an example of an inverted yield curve. This is kind of a flat yield curve, and this is a normal yield curve. Right now, our yield curve is looking like a bit of a U, which is why I left it out of that video, because it takes a little bit more explaining. A lot of times, you're going to see a yield curve look like a U when it's in the process of inverting. If we go back and layer the last 3 months on top of each other, we're going to see in December, the yield curve was pretty normal. We saw that every single interval, the interest rate went up. And then in January, those middle term yields like the 1-year, the 2-year, the 3-year, the 5-year, and the 10-year, they started to drop below the 1 month, which was definitely concerning. Now, the 1 month hasn't really moved all that much, but the rest of the yields have continued to go to the downside, which means that we're in the process of inverting. But why does all of that matter? Well, guys, the reason that matters is because traditionally when the yield curve inverts, it's predicting a recession. As you can see right here, we have a graph of the last 40 years of the economy, and we can see a historical 10-year to 2-year spread on treasury yields. What's the difference in return between those two time periods is basically what it's saying. And whenever that goes into the negative, you can see that very soon thereafter in these gray areas, we have a recession. For example, in 2008, an inverted yield curve and a negative spread on the 10 and 2-year predicted that recession. The same thing happened in 2001 with the dot-com bubble. Same thing happened in 91, right around the time the Soviet Union collapsed, and a few times back in the 80s. As you can see, the spread dropped to just 0.05% very recently. Now, that's happened before. As you can see over here on June of 1998, we dropped to negative 0.05%, which is basically hitting zero. All of this being a long-winded way of explaining to you guys who might not have known what a yield curve was, that Bitcoin and cryptocurrencies and the traditional finance markets seem to be moving towards recession in the next 2, 3, 4 years. It doesn't necessarily mean it's going to happen this year. It doesn't necessarily mean that It doesn't necessarily mean that the news, that was a legitimate, stop. I didn't even plan that. It doesn't mean that the news is going to cause a major global recession, but, it's very possible. The yield curve isn't looking very good right now, but of course, guys, it is just one technical, and you want to take a lot more into consideration than just that. We've been in a bull market on the stock market for over 10 years now. That is not very normal. Normally, you don't go that long without some kind of major pullback and recession, which isn't a bad thing, guys. I need you to remember what I said in yesterday's video. Most of the people that are very wealthy in this world world got very wealthy during a recession, so make sure that you guys are positioned for that when the next one inevitably happens, because of course there's going to be one, we just don't know exactly when. When it does happen, you're ready, because you know what's going to happen the next time a recession hit? Bitcoin may or may not tank, but I'll tell you something that will tank. Real estate. Real estate values are going to fall through the floor. And when they do, I'm going to be sitting there on a big pile of Bitcoin earnings and lock in all of those gains for myself and my future generations. Guys, the people that became rich and they flex with their rented Lambos and their Shopify stores, throwing total shade at you guys over on Instagram. Those guys, they became rich during a bull market and during a major period of growth for the global economy. Show me that you can do that during a recession. I want to show myself that I can do that during a recession. That's when I'll be impressed. Because most people run for the hills, but those of us who decide that we want to stay behind and pick up the pieces and rebuild what happened during that crash, those are the people that really make it big. I can't drill it into your head enough. A pullback and a recession and a correction or a crash on Bitcoin or whatever you're looking at is not a bad thing. It is an opportunity just like anything else. If you go through life saying, oh, I wish this hadn't have happened, or oh, I really wish I hadn't have gotten into that situation, or oh, that relationship was really bad, and you're just complaining about absolutely everything instead of leaving the emotion behind and learning the lesson and moving forward with just that, then you're never going to progress in life. If you guys are here to trade cryptocurrency on the daily, then you're probably trying to be an A-type personality. You're trying to become rich. You're probably trying to become wealthy and improve yourself on a day-to-day basis. Make sure that you're looking at everything as an opportunity and stop complaining, because I see too many people doing it. So anyway, guys, I hope you learned something in today's video, especially if you weren't already familiar with what an inverted yield curve is, because that term gets thrown around on the media all the time, but no one ever really stops to explain what it is. So hopefully you guys have a better understanding of it now. We'll be continuing to discuss traditional markets here on the channel as they continue to take their tumble. So hopefully you guys are looking forward to that. And I hope you guys did enjoy today's video. If you did, hit that like and subscribe button. It really helps out the channel when you do that. And give me a comment down below to read. I love reading you guys' comments. It is honestly one of the highlights of my day, going through and hearting all of them. I do read your comment if I heart it. Sometimes I can't get back to all of them because there's so many of you guys now, though. So anyway, with that said, I'm going to go ahead and wrap the video out. But before I go, I do first want to thank each and every single last one of you for watching, as always. And I will see you guys in the next video. Peace.
Oh, I got a real good